And let's get some analysis with Chief Economist at AMP, Shane Oliver. Shane, the Prime Minister cautious about giving the RBA advice through his analysis. Let's get your analysis. Will the RBA look at that CPI number this week and potentially cut rates come February?
That's right. I think it potentially will, but it all comes down not so much to the headline rate, which of course the Prime Minister is referring to there, which we think will probably come in around 2.4%. It all comes down to the underlying rate. The Reserve Bank knows all too well that the headline rate has been brought down by those cost of living measures, particularly for electricity, but it also knows that they could well prove to be temporary. It's not the underlying rate. So they have to focus on the underlying trend in prices in the economy. That's what they will do. They'll focus on the trim mean. And that will be key in all of this, not the headline rate, the trim mean. And if it comes in where we expect at 0.5% or 3.2% for the year, then I think it will be very hard for the RBA not to cut when they meet in February. Yeah, we're reasonably optimistic here. We have seen increasing evidence through the monthly inflation numbers that have already been released up to November that things are going in the right direction, but it's not fait accompli. It's not certain. I'd have to say it's about a 70% chance they'll cut in February, but it all does come down to how that trimmed mean or the underlying rate of inflation comes in on Wednesday.
The other economic figure that economists point to in terms of saying, will they or won't they go, is the unemployment rate. It remains low unemployment. Does the RBA have to revise the level at which it considers appropriate to start reducing interest rates?
Look, I think they probably do. They have a view that the so-called NAIRU, the non-inflationary rate of unemployment, the non-accelerating inflationary rate of unemployment, so that's the rate of unemployment below which inflation starts to accelerate and above which it decelerates. They have a view that that sort of full employment level is around 4.5%. And they might conclude that, well, 4% unemployment means we've still got a very strong labour market, it's still too strong, and therefore they can't ease. By the same token, the only reason you really worry about the labour market is if it is putting upwards pressure on wages. And as we stand here at present, it's not. Yes, there's issues in parts of the public sector, most recently train operators in New South Wales. But if you look at headline wages growth or underlying wages growth, it's come down from a peak of 4.3%, currently 3.5%. It's actually been slowing, suggesting that the so-called natural rate of unemployment, or the NAIRU, to put it technically, is more like around 4%. In other words, we're not at a point where the labour market is overheating. That shouldn't be a barrier to cutting rates. So I think it all comes down to the inflation numbers. Of course, if the inflation numbers are on the high side regarding the trim mean, the Reserve Bank may say, well, we've still got problems here, and the low unemployment rate is a sign of that. But I think if it comes in on the low side, I don't think the low unemployment rate nor the low Australian dollar should be a barrier to them easing when they meet in February.
Yeah. Well, I know you're an economist, and but there is politics that enters some of this. When you look at the Prime Minister talking about the way reducing inflation, it's been like landing a 747 on a helipad. It's interesting they go along those lines, and they'll be arguing the case that inflation has got a 2 in front of it, and there's been huge progress, and put, I guess, as much pressure on the RBA as they can, while still suggesting that the RBA board has its independence and we're not trying to jawbone them. Yeah,
I mean, we have seen a bit of jawboning. It's not so explicit, but it is implicit in some of the comments we've seen from the government, particularly the Treasurer, over the last year or so. But at the end of the day, the Reserve Bank has to make its own call. They are charged with getting inflation back to target on a sustainable basis, and therefore they have to put all the political pressure aside. Yes, there is some merit in the argument that the cost of living measures, by helping to get headline inflation down, have helped lower subsequent inflation, because if headline inflation is, say, 2.4%, which we think it will be when the numbers come out, then that means lower wages claims down the track. It also means lower indexation of some prices, which are pegged to previous inflation. So that helps. But I think those things are only worth about 0.1% or so off the trim mean. At the end of the day, the Reserve Bank has to focus on the underlying trend in inflation. That is the trim mean. It has to put the politics aside, just as it did at the time of the last election when it decided to raise rates. in May of 2022,
exactly.
just ahead of the federal election at the time. So they have to be absolutely independent here. If they're not, if they're seen as responding to political pressure and say cutting rates, even if the trim mean inflation is still too high, then the market will see through that and push up bond yields, and they'll start to lose credibility.